Hello investors. It's been another good month for your portfolio. We've outperformed the index. Actually, whenever I say outperform the index, there's a feel good about it. And sometimes I kind of wonder, what is it about this index? Why beating the index is so important? What is this enigma called the index? And when you see with time, you'll find fewer and fewer managers can outperform the index over a long period of time. What is this animal that is so powerful? It is even getting more relevant in your lives now because we have this new cult of ETFs or passive investing that is coming in. And this is a tsunami in the US. It is going to hit India also. So if funds are going to move from active to passive increasingly, what is the speciality about passive that is making it so difficult to beat? We are an active fund manager and we need to do a deep dive into it. Some of the numbers that we came out were very, very interesting. And I'm going to share that with you today as to really how to beat this index over a period of time. So the first slide I want to share with you is the Sensex in 1992. Why 1992? Well, I have a bit of sentimental reason connected with that. I came in the markets in 1991. I also think that those were the Renaissance moments. The Harshad Mehta bull market brought about a lot of reforms. And we have very good data from that point in time. Also, the thing is that we can see continuity and recognize a lot of companies that were there then and are still there now. So what you will see on the left is the Sensex in 92. Remember, in 92 there was no Nifty, there was no NSE. On the right column, you will see the Sensex as it is right now, November of 23. When we looked at it, we realized that only 6 stocks survived in this journey of 30 plus years. That means only 20% of the stocks actually survived in the Sensex. In fact, 80% stocks got eliminated. And when I went and looked at the right column and tried to figure out those stocks that were very much there and created wealth, I realized that the 2 sectors which are the biggest weightage today, banks and IT, were not even present in 92. So really the Sensex is not so passive. We call it a passive index, but actually it's not so passive. You can see the kind of movement that has happened. And in this, if we add another equation of the number of stocks that entered the Sensex and exited, of course the calculation will be complex. You'll realize that the survivorship bias is even lower. So clearly, when we say we are investing in a passive index, the index per se is not passive. The index inside is actually very active. That was about entry and exits, but ultimately for investor, what matters is outperformance and returns. So over this 30 plus years, the index has given us a 12.1% return. And we went and looked at those stocks that actually outperformed. Only 9 stocks have outperformed the index. That means only 30%. 70% of the stocks have actually underperformed the index. And mind you, this list of 30 is a very marquee list. These are the 30 largest listed players generally by market cap. They are the big players, they are the big giants. If you go back in 92, and as I said, for people who've been in the market, they will recognize that a lot of them were marquee names. But even more shocking is that you'll realize that for 9 outperformers, there were 9 actual wealth destroyers. These were companies that did not even give you returns equivalent to a fixed deposit rate over 30 years. So that really tells you that even in the index, even in the best of stocks, even in the marquee names, the number of stocks that underperform is far greater than the outperformer. We like to talk about the outperformers. We like to make stories about them, but people tend to forget. 2 such stocks come to mind in the right-hand list. One is Hindustan Motors and Premier Auto. No returns over 30 years. And for people who've been there in that point in time, You would remember that there were months and months of waiting for their cars, which were a status symbol. Who would have thought that 30 years later, these companies would have been gross wealth destroyers? So really trying to predict what is going to happen in the next 5 trillion, 10 trillion economy, which stocks are going to make money, I think is a little bit of an overstretch. Honestly, we really don't have a clue. Ultimately, what wins is the process. That is why you'll find that the Sensex can be beaten by only 9 stocks. Most stocks, 70% have underperformed. So that really shows you the power of the process over and above the power of prediction, which is very much what the whole storytelling scene is in our industry. The next is an even more interesting slide. It may be a controversial from the calculation point of view, but for simplicity, what we have done is that we have taken out the 30 plus CAGR returns for each of the stock and then averaged them. Of course, ideally we should have used market cap and other variables, but for purpose of simplicity, and as I said, this is an approximation, we have really assumed that what if we didn't change any of the components as they were in 91, 92? What would have been the index today? You know, a lot has changed in the way index was calculated, the Sensex. It was first based on market cap, then it moved to free float. So as I want to share this disclaimer that this is a rough estimate and not an accurate number, but it gives us a sense or drives home the point that we think is very, very important, that if the index or the components were kept constant as they were in 1992, you will find that the index return was only 8.8. So you may say 8.8 to 12, well, the gap is there, but not so much. Let me shock you with another piece of numbers. Now, assuming that we had invested in the index in 1992, the Sensex was 1957. As of today, it's at 67, 68,000 plus, so which is a 12.1% kind of CAGR. The more interesting part is that if the constituents had remained the same and we had compounded at 8.8%, you will have found that the Sensex would be 26,740, which is 60% lower. So if the Sensex was truly passive, in the sense that the components were not changed from 1992, we would have not even been at half where we are today. In fact, we would be 60% lower than where we are. And if we put it into the whole power of compounding about wealth creation, a 13 crore consistent portfolio composition versus a 34 crore if the churn is there and as the Sensex stands today. So this gives you a sense of how important churn is to the Sensex. In fact, the alpha has been created by the churn. Well, we decided to dig in deeper and see how this churn is done. What is the secret of this churn? What is so special? Well, it's very clear that this happens twice a year. Of course, the major consideration is market capitalization. Liquidity, industry weightages also matter. But what the Sensex rebalancing does is that those companies that do well, where the market cap goes up, the top 30 get included. Whatever fails or the prices come down, the market cap comes down, they get eliminated. So in all its simplicity, it is all about buying strength and selling weakness. The Sensex is a survivorship bias game. That means stocks that do well get included and stocks that don't do well get excluded. So the interesting thing is that an instrument that has no prediction, which is just a process. Here there is no prediction of GDP, sectors, meeting managements, channel checks, etc. It is just the process that ultimately triumphs all prediction. And that, we think, is the big takeaway for us. It is more relevant for us because we feel that outperforming the Sensex is challenging because actually in the Sensex there is an inherent trend following strategy. What is trend following? Trend following is buying strength, selling weakness, and that is what the Sensex is doing. So I would like to summarize by saying that we at Marathon Trends are trend followers, and we believe that the tailwinds of or the proven technique of the Sensex, which successfully trend follows, is visible to us. And for our fund, what is the edge? The edge is our ability to be agile. How we are agile, how do we do it? We'll share it with you in another video. Thanks for now. Bye-bye.